Hey there, it's Master Strikes, ready to break down a crucial economic indicator that can make or break your portfolio, the Non-Farm Payrolls or NFP report. This bad boy drops on the first Friday of every month, and trust me, it sends shockwaves through the market. Why? Because it gives us a sneak peek into the health of the US economy, specifically the labor market. Now, you might be wondering, Jim, what's the big deal about some job numbers? Well, hold on to your hats because this is where it gets interesting. The NFP report doesn't just tell us how many jobs were added or lost. It also hints at wage growth and the overall strength of the economy. And guess what? This little piece of data has a ripple effect on everything from stocks and bonds to currencies and commodities, especially our shiny friend gold. You see, gold is like that cool kid in school who everyone wants to hang out with when things get rough. It's a safe haven asset, meaning investors flock to it when they're feeling uncertain about the economy. So when the NFP report comes out, it's like a report card for the US economy. A good report card usually means a stronger dollar and less love for gold. A bad report card, well, that's when gold shines. So buckle up, because in the next few sections, we're diving deep into the nitty-gritty of NFP data and its impact on gold prices. Get ready to make some serious money moves. Alright, let's break down this NFP thing like we're analyzing a hot stock tip. First off, what exactly does it measure? Simply put, the NFP report tells us how many jobs were added or lost in the US economy, excluding a few sectors like agriculture and government. Think of it as a snapshot of the private sector workforce. But wait, there's more. This report is like a three-course meal for investors. It also gives us the unemployment rate, which tells us what percentage of the workforce is actively looking for jobs but can't find any. And for dessert, we get wage growth data, which shows us how much workers' earnings are increasing. Sweet, right? Now, why should you care about these numbers? Because they paint a picture of consumer spending power. More jobs and higher wages usually mean people have more money to spend, which is good news for the economy. On the flip side, fewer jobs and stagnant wages can signal trouble ahead. So there you have it. The NFP report is like a monthly checkup for the US job market, giving us valuable insights into the economy's overall health. Stay tuned because, in the next section, we'll explore how this data impacts the big kahuna, the Federal Reserve. Hold on to your seats, because we're about to talk about the Federal Reserve, the big cheese of the US economy. These guys are responsible for setting interest rates and controlling the money supply. And guess what they rely on heavily when making their decisions? You got it, the NFP report. You see, the Fed has a dual mandate to keep inflation in check and to promote maximum employment. They're like the economic superheroes, trying to balance the delicate scales of economic growth. And the NFP report is like their trusty sidekick, providing crucial information about the employment situation. When the NFP report shows strong job growth and rising wages, it signals a healthy economy. The Fed might interpret this as a sign that inflation could be heating up, leading them to raise interest rates to cool things down. On the other hand, weak job growth and stagnant wages could indicate a sluggish economy, prompting the Fed to lower interest rates to stimulate growth. Now, this is where it gets really interesting for gold bugs like us. Remember how we talked about gold being a safe haven asset? Well, the Fed's actions have a direct impact on gold prices. When interest rates rise, gold tends to lose its luster because it doesn't pay any interest. But when interest rates fall, gold shines bright like a diamond. So there you have it. The NFP report is not just about job numbers. It's a key driver of Federal Reserve policy, which in turn influences the price of gold. Stay tuned because in the next section, we'll delve deeper into the fascinating world of gold and its role as a safe haven asset. Let's talk about gold, baby. This precious metal has been a symbol of wealth and prosperity for centuries. But here's the thing, gold isn't just a shiny bauble. It's a strategic asset that can protect your portfolio when the market throws a curveball. Why is gold considered a safe haven? Well, unlike paper currencies, gold has intrinsic value. It's a tangible asset that can't be printed out of thin air like our friend, the US dollar. This makes it a hedge against inflation, meaning its value tends to rise when the purchasing power of fiat currencies declines. But that's not all. Gold also shines during times of geopolitical uncertainty and economic turmoil. When investors get nervous about the stock market or global events, they often flock to gold as a safe haven, driving up its price. It's like the ultimate insurance policy for your portfolio. Now here's where it gets really interesting for us NFP watchers. Remember how we talked about the Fed's response to the NFP report? Well, their actions have a direct impact on the US dollar. And guess what? Gold and the dollar usually move in opposite directions. When the dollar strengthens, gold tends to weaken, and vice versa. So, there you have it. Gold is a fascinating asset that plays a crucial role in the global financial system. Its price is influenced by a multitude of factors, including economic data, geopolitical events, and central bank policies. And as we'll see in the next section, the NFP report is one of the key drivers of this intricate dance between gold and the dollar. Alright, so let's dive into the relationship between non-farm payroll data and gold prices. You see, gold is often considered a safe haven asset. When the NFP data is strong, it usually indicates a healthy economy, which can lead to higher interest rates. Now, higher interest rates tend to strengthen the dollar, making gold less attractive because it doesn't yield any interest. So in many cases, a positive NFP report can lead to a drop in gold prices. Conversely, when the NFP data is weak, it can signal economic trouble, prompting investors to flock to safe haven assets like gold. This increased demand can drive up gold prices. It's fascinating how these two seemingly different elements are so interconnected, isn't it? Understanding this correlation can really help investors make more informed decisions. So whether you're a seasoned trader or just getting started, keeping an eye on the NFP data can give you valuable insights into the gold market. Let's dive into the historical analysis of non-farm payrolls and gold price movements. Over the years, we've observed some intriguing patterns. Generally, when NFP data exceeds expectations, gold prices tend to drop. This is because stronger job data often leads to expectations of higher interest rates, which can make gold less attractive. Conversely, weaker NFP data can result in higher gold prices as investors seek safe haven assets. However, it's important to note that these trends are not set in stone and can be influenced by various other factors. Now let's explore the factors influencing the relationship between NFP and gold. Economic indicators such as inflation, interest rates, and geopolitical events play significant roles. For instance, rising inflation can boost gold prices as investors look for a hedge against currency devaluation. On the other hand, geopolitical tensions can drive investors towards gold as a safe haven asset. Additionally, central bank policies and market sentiment are crucial in shaping this dynamic relationship. Moving on to strategies for trading gold around NFP announcements. One effective approach is to monitor the market sentiment leading up to the release. Traders often position themselves based on expectations, so it's essential to stay informed. Another strategy is to wait for the initial volatility to subside before making a move. This can help in avoiding false breakouts. Additionally, combining technical analysis with fundamental insights can provide a more comprehensive trading strategy. It's all about being prepared and adaptable. Finally, let's discuss the broader implications of NFP data for gold investors. Beyond immediate price movements, NFP data can offer valuable insights into the overall health of the economy. A strong labor market can signal economic growth, which might lead to higher interest rates and a stronger currency. For gold investors, this means staying vigilant and considering the long-term economic trends. By understanding the broader implications, investors can make more informed decisions and better navigate the complexities of the market.